Global market conditions were supportive in November, consolidating the positive trend that started in October following the market sell-off in this summer. Equities in Europe and in Japan outperformed US markets as we had expected, while US Treasury yields moved higher as a result of expectations that the Fed will start to implement its tightening cycle in December this year. The monetary policy divergence between the ECB and the Fed continued to support trends in FX and commodity markets. The US dollar continued to appreciate significantly against G10 currencies, while commodities and in particular energy were on a downward trend. This environment was broadly supportive for hedge funds, which were up 0.5 percentage points in November, following a 2 percentage points rise in October, and hedge funds are now on track to deliver a solid Q4. Global macro and long-short equity strategies outperformed, and this confirms the outperformance that we have seen earlier in the year. Macro funds were supported by the equity rally, by the USD appreciation, while relative value positions in fixed income also contributed to the performance, while long-short equity managers moved higher as a result of the outperformance of Asian and emerging market long-short equity funds. Meanwhile, event-driven funds underperformed in November, again confirming the previous trend of underperformance of this strategy. Event-driven managers were impacted negatively by their exposure to the energy sector and their exposure to the healthcare sector as well, which was under political pressure. Going forward, we expect that the market environment will be less supportive due to the fact that the first rate hike by the Fed in a decade will possibly impact negatively market confidence. In this environment, hedge funds are set to outperform traditional asset classes, as they have done in the past when market conditions were less supportive for traditional assets. We have recently upgraded European long-short credit due to the fact that the ECB easing is likely to support the directionality of this market. On the other side, we have downgraded recently event-driven managers and in particular special situation funds due to their market directionality and their exposure to the healthcare sector. We continue to express an overweight stance on global macro and CTA funds, and in particular for those managers with less market directionality. And finally, we also continue to express an overweight stance on long-short equity funds with limited market directionality, such as variable biased and market-neutral long-short equity funds that are likely to navigate more easily the environment in the next few months.